Thank you for checking out Real Talk Personal Finance. It's about to get real. Cash Flow King with you today, and today in episode 31, 15% promissory notes. Damn good or dog shit? Thanks for tuning into the show. Really appreciate it, and thanks for your patience in us getting out the next episode. I am not publishing nearly at the frequency that I would like to, but life gets busy sometimes, and quite frankly, it is what it is. Want to thank all of our listeners. We are still at 21 countries. Still hard to believe. I think that's fantastic. Obviously, would love to continue to grow the show. So if you're enjoying it, please feel free to share it with a friend, family member, coworker, whomever you think might benefit or be entertained by listening to the show. Since I haven't really given a lot of love to the U.S. lately as far as mentions on the show, and again, we appreciate everybody, I thought I'd take a minute to just name the top 5 U.S. states in terms of listenership in no particular order. We have Kentucky, Pennsylvania, Indiana, California, and Florida. So thanks especially to those in those states. And if you didn't hear your state and you're listening to the show and you want to be on the list, again, feel free to share it, and hopefully we can get you up on the list and get you a shout out in the future. If you have any questions, comments, show ideas, or you're fucking bored and want to send an email, feel free to email the show at realtalkpersonalfinance@gmail.com. Again, that's realtalkpersonalfinance@gmail.com. If you don't want to remember that or write it down, I added some information now. There's a little feature on Buzzsprout, which we are a Buzzsprout affiliate, so shameless plug. If you're thinking about starting your own podcast and you'd like a $20 Amazon e-gift card after your second paid month of membership, feel free to use the link in the show notes and get that deal for yourself. Support the show. We'd really appreciate it. But I am adding in some information, a couple of the affiliate links, as well as the email address for the show, so that you should be able to find that now at the bottom of every show in your podcast player. So if you don't want to remember it or type out an email by opening your email app, if you simply click on the link to realtalkpersonalfinance@gmail.com in the show notes, it should automatically open that up for you, and you can feel free to zap a quick one over to the show. So today, we're going to talk about something that I am relatively new to. So one thing that I enjoy doing, and I'm going to start to bring that, I think, a little bit more and more to the show, is just exploring different types of investment opportunities, maybe some that are not quite so, vanilla or traditional, right? Most of us are familiar with retirement plans and the stock market and things like that. And that's all good and well. We'll still talk about that shit on the show. But there's going to be other things that come up that may be intriguing or interesting. And I thought it would be kind of fun to bring that to the show a little bit, especially as I personally am sifting through different types of opportunities for my own investment portfolio and considering different things. I thought, why not bring that to the show? So we are going to talk about promissory notes today, and as you can see by the title, 15% promissory notes, damn good or dog shit. I want to start off with a disclaimer. We don't give any advice on the show, as we've said pretty much every single episode now. The show is for entertainment and educational purposes only. Always do your own due diligence and make your own decisions. But this is something that I'm considering. We are not offering promissory notes. We are not a syndicator. We are not raising money. We don't want your fucking money. So this is not anything to do with that. This is simply, hey, Cashflow King is thinking about a couple of things and thought it would be kind of a cool exercise in critical thinking and just fun to talk about on the show. And quite frankly, this is in some way, shape, or form maybe my own form of therapy by voicing my thoughts and opinions and recording it and putting it out for your entertainment. So that's kind of what today is going to be. So before we get into all that and what I'm considering and why and all that shit, first let's talk really quick about promissory notes in general. What is a promissory note? And in its most basic form, it is a legal lending document where a borrower promises to repay a lender a certain amount of money in a certain time frame. And you're going to have the amount, you're going to have the interest rate, you're going to have the frequency, and quite frankly, you've probably signed a promissory note or perhaps multiple promissory notes at some point in your life, right? If you've ever gotten a mortgage, a car loan, you have student loans, you've done business loans, personal loans, whatever the case might be, chances are you have affected a promissory note in some way, shape, or form. So it's probably something that you're more used to than you think. But when you think about it, okay, I want to go out and get a car loan, so I'm going to sign this promissory note for the car loan. You're not really looking at it as an investment. Most of the time, you are the borrower. But what happens when and if you decide to become the lender? And that's what we're going to talk about in today's show. I was thinking back to, I think it was 2 episodes ago, I did an episode on car washes and why I was not going to invest in a particular car wash syndication yet. And that is still the case. But this is a slightly different type of, or very different type of investment opportunity that I have come across, and I'm going to be very careful to not name individual names. I don't want to name company names. This is not meant to be any sort of recommendation or that you should or shouldn't do this. This is simply something that I came across that I'm considering doing myself, and I just kind of wanted to put it out there. But we're looking at it from the standpoint of me becoming potentially a lender as an investment. So before we get into it a little bit further, let's back up for just a second and really ask the question, like, why am I even talking about this and why am I even considering this? And so, as I've mentioned, and we've done shows before, I think we did a mini series on passive real estate investing. I invest in multiple different areas in the real estate space, among other things. And I do have a particular investment, or 2 actually, that are going to be coming due and the funds are going to be returned to me. So I am currently actively looking for places to redeploy that capital. And so one of the things that I was thinking about, as I recorded and just mentioned a couple of shows ago, was car wash syndication. And now I'm looking at a promissory note opportunity. And I'm also looking at, we're not going to really talk much about it today, but there is another mobile home park syndication that I'm going to be exploring. So I got, a lot of feelers out there, and I'm looking into different things. But what I'm trying to do, as my name, Cash Flow King, might lend itself to, is I'm trying to create yield. I'm trying to create cash flow, because when these investments in my particular case get redeemed, I'm going to be losing a certain amount of cash flow each month from the investment that the funds are in currently, and I would like to be able to try to replace that or possibly even exceed what I am currently receiving. So that's kind of how this came about. And generally speaking, there's some sort of a correlation between risk versus return or risk versus reward. And anytime you hear numbers that kind of sort of sound almost too good to be true, you really have to scratch your head, and it makes you wonder. And that's kind of where I'm at with this particular investment opportunity. So I came across an investment opportunity where I could become the lender on a promissory note, earn 15%, and I am considering whether or not I want to do that. And I'm going to argue both sides. I'm going to make an argument, or try to make an argument, for why I would consider doing this. I'm also going to try to make an argument for why maybe I would not consider doing this. And you as the listener can ultimately decide. And if you want to have some fun, again, email the show and let me know. What do you think? Damn good or dog shit? So here we go. The only thing that really matters at the end of the day, right, is whether or not on this investment you actually get paid. So they can promise whatever rate of return they want to. 5%, 10%, 15, 5,000, or something ridiculous, whatever. But none of that matters unless you actually receive that return. And as I mentioned a little while ago, I don't have all the answers, and I'm trying to figure out whether or not this is even feasible. So I've begun my due diligence process, and again, this is sort of an exercise in critical thinking, and I kind of wanted to just open that up and sort of be transparent with you as the listeners to kind of go through what I'm thinking about and conversations I've had and sort of, what it all means. And this may or may not apply in your situation, but if nothing else, hopefully you get some entertainment out of today's show. So I am considering essentially making a loan and being the lender to a business in the form of a promissory note, where that business is going to pay 15% interest annually, and they're going to make those interest payments on a monthly basis. So whatever amount of money I decide to invest, if I decide to invest, they're going to pay 15% on that, and they're going to pay me monthly. Now, there aren't too many investments out there today where you can earn a fixed rate of return of 15%, right? Depending on what you're talking about. If we talked about, and going back to our real estate mini-series, and we think about things like a multifamily syndication, self-storage syndication, some sort of passive real estate investment in the form of a syndication, your IRRs, your internal rates of return, when you consider everything over time and you plug in the numbers, those can easily be in excess of 15%, right? And that wouldn't really alarm me, but that's not what we're talking about here. We're talking more of a cash yield or an interest payment specifically in this case that would be the equivalent of 15% per year. And there aren't too many investments out there today, at least not any that I'm really aware of, other than maybe an operational business, where you can passively invest a sum of money and earn a steady, fixed, and pretty much a sustainable 15% or quite frankly, anywhere close to that. Now, obviously, rates are on the rise. We are in, as we've talked about on the show before with Cube Crusher, we're in an inflationary environment. We talked about what's going on with the Fed and raising rates, and that seems to be continuing, at least as of the current time. I'm recording this on November 17th of 2022. And so a lot of people, myself included, are looking for yield, right? And as rates are coming up, it seems to be, in a lot of types of more traditional investments, easier and easier to come across a decent yield, but 15% seems way the fuck out there, quite frankly, right? So that's why I'm having such a hard time with this one. So anyway, it would be a business loan, right? I'm going to be the lender. I'm going to make a loan to a business in the form of a promissory note at 15% interest. They're going to pay me monthly. And then my principal, whatever amount I invest with them, lump sum, is going to be repaid at maturity. And I can choose, there's flexible terms, pretty much any length of time that I want in terms of the number of years that this note would be good for. Now, my first question, and what you're probably thinking, is how the hell can they pay that, right? And that's a pretty good question, for pretty good initial thought, I would think. And so what are they doing? And again, I'm going to do my best to not name names, not name company names or anything like that. This isn't a plug for anybody. I just got to be careful what I say because I don't want to make it overly obvious as to what specifically I'm talking about. But essentially, if I make this loan to this business, what they're doing is they are using investor money to fund a portfolio of other businesses, formerly distressed businesses, that they've essentially taken over and repositioned. And they're starting to continue to grow other new businesses in addition to that. So it's kind of a hybrid. You have a lot of well-known names and brands that at one point in time maybe were not doing very well, but there's a lot of brand recognition. There's some sense of brand loyalty, right? There's sort of the brand equity, if you will, that exists with these businesses, and they are turning them around. And a lot of these businesses were historically brick and mortar locations that they're taking pretty much exclusively online. And they are doing a lot with e-commerce. They're doing some newer ventures with some other firms that, quite frankly, are very, very big in certain spaces. And there's a little bit of exposure. Cube Crusher might like this. I still don't invest personally in shitcoin, but there's some crypto exposure, not so much from the investment standpoint, but in terms of what they are doing with investor money and the types of businesses that they are turning around and investing in. And then there's some other areas as well that are completely unrelated to crypto, completely unrelated to e-commerce, that are sort of more, I guess you could say, brick and mortar style of businesses. So essentially, they're taking investor money and they're in sort of hyper growth mode, and they're using it for a multitude of purposes and essentially investing in a portfolio of businesses of different types. Many of those are e-commerce. There's a few of those that are crypto. There's a few of those that are other. And that is essentially what is going to supposedly allow them to be able to pay 15% interest on these notes, because these businesses, these operational businesses, many of which are already profitable, that they're investing into will hopefully continue to produce returns well in excess of the amount that they're paying to the investors. So that's kind of the play. And so that leads us into the next point of unsecured versus secured types of promissory notes. If you've ever gotten a car loan, again, a mortgage or anything like that, there more than likely was collateral, right? Your home or your vehicle or whatever the case might be to that promissory note. If you don't pay, and again, flipping back to you being a borrower now, not a lender, but if you were the borrower and you didn't pay, then there was collateral attached to the note. They could essentially come back and take that collateral back, and that's one thing that sort of makes the lender feel warm and fuzzy about making that loan. Well, in terms of what I'm talking about in this particular opportunity, it is not a secured promissory note. It's actually an unsecured promissory note, which normally, quite frankly, I wouldn't touch with a 10-foot pole. And so that's why I've been scratching my head so hard over this. And I've had several calls with this particular company, and I actually had a call with the owner yesterday. We were on the phone for almost an hour, just kind of going through, what are you doing? How are you doing it? All the questions that you would normally want to ask. And we had an interesting conversation about the quote-unquote risk. And I want to know what you guys think about this, so feel free to email the show. But the quote-unquote risk of unsecured versus secured promissory notes. And I personally believe that if you have a secured note and there is collateral behind that note, it would make me as a potential lender, right, as an investor, I would feel more comfortable. If you told me you were going to pay me X percent and you signed a promissory note and you had a vehicle that generally held its value as collateral, I know if you don't pay the note, I'm going to take your fucking vehicle, right? That's the collateral. But without that, if you don't pay, you're signing a promise to pay. But if you stop paying or you don't make good on that and it's unsecured, I don't have anything to go after. So in my personal opinion, a secured promissory note would almost always be quote unquote less risky than an unsecured promissory note. And when I had this conversation with the owner of the company that's making this particular offering, he had another perspective on it. And I'm trying to decipher, okay, is this, am I just missing something here, or is he just trying to sell me, right? And by the way, this is somebody that has a very, very good reputation. They've been around for decades. They have other businesses that are somewhat related to this, although they are a little bit different. And so if this was somebody that I didn't know at all, that didn't have a reputation to protect, I probably would have dismissed this a long time ago, and I never would have recorded this podcast in the first place. So I do want to say that. But really thankful that he took the time to talk with me. But we're talking, and he says that if you look at something like this, like their particular offering that is unsecured, that it's actually less risky than a secured promissory note. And he went on to talk about these businesses that I had mentioned and alluded to, and I'm not going to go into great detail, but he was able to share more specifics about what they're doing, how they're doing it, why they're able to offer the returns that they're able to offer, so on and so forth. And he actually made somewhat of a compelling argument as to why somebody might consider this. But in his mind and opinion, and what he was saying is, look, we have a portfolio of businesses that we're essentially taking the investor money and growing these other businesses. And if one or two of them flop for whatever reason, you still have the other ones that are essentially, they're not technically collateralizing the loan or securing the promissory note, but all of those essentially would have to go belly up for them to not be able to make good on that interest payment. And that was his viewpoint. And he talked about what he called brain damage on secured. So he says, what happens if, let's say in the real estate world, for example, you have somebody that is a private money lender and they lend money to a house flipper, and the house that investor is flipping is the collateral. So if the investor doesn't pay back the hard money loan, then the hard money lender can go back and take the home itself as their collateral, right? We just talked about that. But his point was, look, there's a lot of things that need to happen in order for you to feel good about that piece of collateral. And you have to go through the quote-unquote brain damage exercise of actually taking back the collateral, right? You have to take time. You have to take energy. You're probably going to have to hire an attorney. It's going to cost you money. And then finally, when, in the case of the house flipper example, you get the asset, chances are that investor that took the hard money loan from you was trying to flip the house. The house was distressed, right? It's a dilapidated home. And now you're probably going to have to spend even more money to bring that up to the point where it can be sold for any sort of a profit whatsoever. And so even though it seems quote unquote less risky to have a secured promissory note, that may or may not always be the case. And my counter to that was pretty much, I understand what you're saying and I could see that. But at the end of the day, whether that house is dilapidated or not, even if you didn't want to spend the extra money to bring it up to market standard and get a good price, you could likely liquidate to another investor at a discount, and more than likely it would be at least somewhat salvageable, and you would have some sort of, even if at a discount, collateral that's backing the loan, and you'd be able to get something for the money that you initially lent them. You would be able to get something back. It may not be 100%, may not even be 50 or 75%, but you're probably going to get something back in exchange for that. And so we kind of went back and forth in a friendly, debate about that a little bit. But that was his position, was that unsecured is less risky in this case because you have a portfolio of companies. And my argument was that secured promissory notes, even if the collateral has to be sold and liquidated at a discount if you had to foreclose on it, is going to be the less risky method. So interested to see what you as the listener think. Again, feel free to shoot a note to the show if you'd like to. So that's what we're talking about. The other thing, though, that he didn't talk about, but I thought about after our call, and I woke up this morning and for some reason thought I invented a phrase and was disappointed to find out as soon as I Googled it. I found some other folks that had been using it for a while. But what about something called reputational collateral, right? The note itself might not be secured, right? It's an unsecured note. But what about the company, the business that's getting this loan from me as the lender, as the investor? What about the person that owns that business? What about their reputation? What about their other businesses? And if something did go belly up and investors did somehow get screwed, and they've been in business for decades doing their other businesses that are a little bit different than this, but they're kind of sort of in the same general space, what does that do to their reputation, right? And I feel like they have a reputation in this particular case to protect. And so that's another thing that I thought about is sort of the reputation of that individual, of that business owner as collateral. And that might sound like complete pie in the sky mumbo jumbo, but it is something that crossed my mind. And this particular person, through their other businesses, has done promissory notes in the past. In fact, they've been doing them for over 10 years. And supposedly, I got to dig a little bit deeper on this, but supposedly they've never had a default, right? But they've also never raised money for sort of the pool of companies that they're raising money for essentially now. So it is a little bit different, and that gives me a little bit of pause, but I'm trying to look at this sort of holistically in terms of that perspective. So that's essentially what we're looking at. Me being an investor in the form of the lender, getting a 15% cash-on-cash return in the form of an interest payment, annualized. They're going to pay that to me on a monthly basis, like clockwork. And then at the end of the term, I get my money back if all goes well. If everything goes to hell in a handbasket, on the other hand, though, I lose it all. And I don't have any recourse. There's nothing I can go after. There's nothing securing that promissory note. There is no collateral. There's no physical collateral. So that's kind of where I'm at in sort of pondering this. A couple other things that I thought might be important to mention. One of them, and this is another reason that I was kind of leaning towards, I'm not so sure about this, is how, and again, we don't give tax or legal advice on the show. We don't give financial advice on the show. We don't give any advice on the show. But from a tax standpoint, if you are the lender and you are receiving an interest payment, the borrower in this case, the business, would be issuing a 1099 at the end of the year or the beginning of the next year for the previous tax year for those interest payments. And those interest payments are going to be taxed at ordinary income tax rates. It's kind of like earning an additional amount of interest on, say, a bank savings account, although in this case there's a ton more risk, which obviously is commensurate with the 15% as opposed to maybe the 3% right now you might get on a high-yield savings account, for example, in this environment. So, but that's the other thing, is that you are going to have to pay, or I would have to pay, ordinary income tax on the interest that's earned, which, depending on how you're investing in something like this, if I were to do this, may or may not matter as much. For example, if I invested, which I was considering doing, in something like this outside of a retirement account, then yes, it is going to be taxable at ordinary income, and I'm going to have to pay tax on that interest income every year. And that sucks. There's no depreciation benefit. There's no, other paper losses I can use to offset that. It is what it is. You earn 15%. You're going to have to pay taxes. But even after you do that, if you net it out, depending on what your tax bracket is and everything, the net return after taxes is still probably going to be better than most other yields that you're going to find in today's environment, right? So there's that. The other way to invest, and I know a lot of other investors do this or would consider doing this, is if you have a self-directed retirement account, which I don't know that we've talked much about on the show, and we may or may not do an episode on self-directed accounts at some point, but there are retirement plans out there and different custodians that offer what's called self-directed retirement accounts, where you can invest in sort of the non-traditional stuff, right? If you want your typical stocks, bonds, mutual funds, ETFs, things like that, you can pretty much go to any investment firm or financial services firm out there, and they'll do it. But if you want to invest in real estate, you want to invest in promissory notes, you want to invest in operational businesses, whatever the case might be, you more than likely will need a special type of account for that. Then there are different types of accounts out there called self-directed retirement accounts where you can make certain investments like this and others. And so if somebody were going to do it in that fashion, which I could do, I guess, with other funds, but the funds that are coming back to me are not currently in a retirement plan, so I probably would not be doing it that way. But depending on the type of account that you had, if you had a self-directed account and those interest payments came back into that self-directed account, all that interest would be either tax-deferred if it's a pre-tax account or tax-free if it's a Roth account and you meet certain qualifying conditions. So that would be a good way for people to lend money out of their self-directed retirement account potentially for something like this. And they don't really have to worry about the immediate annual tax obligation. They only have to worry about the tax implications when they withdraw from that particular self-directed retirement account, depending on what type of self-directed retirement account they actually have. So that's sort of the long and short of it. And what we're looking at here, what do you think? Damn good? Dog shit? Am I missing something? Should I be asking additional questions? I try to give you a general overview of kind of my thought process and where I'm at with this. And quite frankly, I'm probably about, at this particular stage, it seems to change lately on a daily basis, but at this particular stage, probably about 40% yes, 60% no on my decision with this, but I haven't made a decision yet. I do like the yield. I do like the cash flow, but again, none of that matters if they can't make good on it. I don't like the fact that it is ordinary income. I don't like the fact that essentially like there's no other potential upside. Not that 15% is bad, but I can probably get the same, if not more than likely a higher projected internal rate of return in some other type of syndication. I could also probably get a lower yield, but I can probably have that yield protected at least somewhat or shielded in the form of another syndication due to some of the benefits that real estate investing typically offers. Whereas with this, there really is no shielding it. You're getting 15% to your face. That's it. You're going to have to pay the taxes on it if you're not doing it through a self-directed retirement account. Do you want to play ball or not, right? And on the last thing, obviously, I don't like the fact that even though I could make an argument that there's some reputational collateral attached to these, there really is no physical collateral. These are not secured promissory notes. And so for those reasons, I would be more skeptical of moving forward. I will say that as far as risk tolerance goes for something like this, my risk tolerance is generally pretty high. But at the same time, I'm trying to look at all the angles. Now, we don't do this type of work for clients, but sometimes I try to put myself in the shoes of a client. And if a client came to me and said, hey, Cashflow King, what would you do in this situation, assuming we could actually advise on this? Again, it's not something that we offer, but I would probably caution them against it. And so my initial gut reaction when I learned about this was, no fucking way. But then after talking to the owner, digging a little bit deeper, learning more about it, I was like, And so 15%, again, pretty good yield in this environment. I think it's a damn good yield. But the problem is it doesn't matter if it's a damn good yield, if it's a dog shit investment. And that's what I'm going back and forth with. So thought I'd make this episode, again, just kind of a quick exercise in critical thinking. I'd be interested to get some feedback from the listeners, again, for educational and entertainment value. I am not giving advice. I'm not necessarily asking you for advice, more so just interested to see the feedback from the Real Talk Personal Finance community. So feel free to email the show at realtalkpersonalfinance@gmail.com if you have any thoughts or anything you'd like to share. With that, thank you again for checking out the show. We really appreciate it. I am going to try to start publishing on a more consistent basis. No promises. We're getting into the holiday season, but I would like to put something out a little bit more often than I have been. So if you have any other show ideas, again, feel free to email the show and check it out. If you're going to start a podcast, again, check out our Buzzsprout affiliate link. Get yourself $20 to Amazon as an e-gift card after your second paid month. It's really not all that expensive if it's something you're considering. And for those of you that are getting ready for Thanksgiving or you don't feel like running to the fucking store or whatever, Instacart. We also have an Instacart affiliate link in the show notes. It does not cost you anything. As a matter of fact, your first order over $35 is free delivery with that link. So feel free to check out and sign up for Instacart. They have different programs available. You're never really locked in anything. Read the terms and conditions, of course, but you can always cancel if you wanted to cancel. We still use it. I think it's fantastic, especially for one of the grocery stores that's across town when I don't feel like getting stuck in traffic. It's really, really easy to just hop on there and, get a few items and have them delivered right to my doorstep. So check out the links in the show notes. Buzzsprout if you want to start a podcast. Instacart if you need some last-minute things for Thanksgiving coming up and you don't feel like running out, or you just don't feel like fucking grocery shopping and you just want to be lazy. It's a great way to do that. And again, you'll get your first order free when your order is $35 or more if you use the link in the show notes. Thanks again for checking out the show. This has been episode 31, 15% promissory notes. Damn good or dog shit? What do you think? Let us know. Thanks so much. We will see you in the next episode.
Check the mic and make sure it sound right, boys.